The Fed's job just got a little bit harder, and their credibility once again is now coming into question after yesterday's speech or Wednesday's speech by Jay Powell. The job report came out, and we have a Jay Powell saying that they are looking at the potential to possibly reduce the pace of rate hikes, is what they said yesterday. The markets rallied on that news because of algorithmic trade setups. The logarithms were programmed for anything dovish by the Fed. Slowing the pace of rate hikes is kind of a phrase that the algorithms will trade on. And then, of course, that creates stop loss hunts and leverages, liquidations. Liquidating shorts and everything on that news, because a lot of people expected, the market mostly expected, a hawkish Fed and a sell-off on that. So all the shorts got liquidated. Algorithms were set up to follow that momentum and continue along that track. But today, market's kind of flat. S&P down just a hair, NASDAQ down a hair, the Dow up a hair. So kind of even market today after the job reports came out. The economy showed a much stronger job market than what the Fed would like. And we obviously saw retail spending at record highs over the holiday. We're seeing a robust, strong consumer wanting to spend, and we are seeing an economy that does not look like it's softening. So apparently what the Fed is doing is not having an effect, not working. We are seeing signs that inflation is possibly peaking, but the things that the Fed measures isn't the reality of what's going on in the streets. And here's the Santa Claus rally right here. Goldman Sachs is warning traders of a shrinking bonus pool as Wall Street hunkers down. Goldman Sachs traders and salespeople will have to contend with a bonus pool that's at least 10% smaller than last year, despite producing more revenue this year, according to people with knowledge of the situation. That's because the New York-based bank is dealing with a slowdown across most of its other businesses. So how do we fix that? We pump the market after we dump the market. That's how Wall Street's going to get their bonuses. So that means Santa Claus rally. So here's the Dow right here, above the major trend that we were looking at yesterday, kind of holding on here, waiting for that next move. And remember, we have all eyes on the VIX. The VIX is now at 19. Last time it was at these levels was August and March, and that's when we had our last couple of big down legs. The Dixie found a little bit of support here, put in a little bit lower low. So the dollar losing steam, and the 10-year losing a little bit of steam as well, down to 3.4, lowering interest rates, which is not good for the Fed either. So we have lower yields on treasuries. We have a weakening dollar. We have a strengthening jobs market. We have record high inflation, not the highest ever, obviously, but record in terms of the last 20 years, and potentially peaking, but not moving backwards fast enough. So the Fed's job has gotten more difficult. So now the big debate again, 50 or 75. Right now, the data would suggest 75 would be appropriate at the next meeting, but we shall see if the Fed wants to deliver that blow to the markets before Christmas, which I would think behind the scenes talk would be, and this is what we're going to talk about with, this is oil right here, retracing a little bit from yesterday's rally. So here's what I was talking about right here. Last time the VIX was at these levels was right here in August, and then back over here in March, April, right in this time frame here from the last big leg down. Here's the NASDAQ, March, April. Here's August. S&P, March, April, August. That's the last time the VIX was at this level. And each of these indexes, the Dow has exceeded the trend line here because capital was flowing into the Dow stocks. But again, the last time these trend lines were tested, didn't quite make it here in March, but definitely rejected off the trend line here in August, and not quite to the trend line there. So is this the last stand for the NASDAQ right here, and kind of going to look like the March timeframe with the VIX where it's at, and then the S&P just barely cracking that trend line. Of course, I haven't drawn these perfect, but you get the point. Rejected off of it each time. Lower highs, lower lows. So what am I talking about with the Santa Claus rally? So let's just take a look at the S&P here, and what would make sense. And from a behind the scenes, hey, Jay Powell, my buddy, we got to hit our bonuses. What do? They dump the market into and ahead of December meeting, thinking that the Fed's going to drop 75 and the Fed or raise rate 75 basis points. The Fed raises rate 75 basis points. Markets put in a new low, and then bam, Santa Claus rally off to the races to check the trend line again ahead of Christmas. And let's see what that would do. So let's just say over the next few days, market kind of continues its way down here and kind of works down, puts in a little bit of a lower low around that 3,400 mark, 3,470, and then works its way back up and bounces off that trend line at 37. So that could be a nice little rally where, let's just look at the past, where the last time the market dropped 18% and then now has rallied, this is S&P, has rallied 16%. So what would that look like here? A drop of 18% on the S&P is somewhere around a little bit lower than what I drew here. But let's see if we can find that. 18% would be around 30, 33.50, somewhere like that. And then from 33.50, if we had a 15% rally, puts you back up into that 37 range. So fairly close, goes a little bit deeper than what I'm showing here, taking out this low, then bounces back to the trend line. And then we get into the debate of recession, how long, how deep, how fast, how far, all that kind of stuff. But that's how we get a Santa Claus rally. So the theory of the Santa Claus rally is the Fed has pumped the market up here, setting the table for this rally to fizzle out. Then the Fed comes out 75 basis points or even 50, market kind of de-leverages and reprices into that move, testing these lows back in October, if not breaking them. And then we're off to the races last couple of weeks of the year, and the market rallies back to the trend before rolling over on itself again. And where do we have precedents for this? Let's just take a look at the S&P, and let's go back to last December right here. And for the month of December, you can see the pattern, right? So it's right here at the beginning of December, market pumps, drops around the mid part of December. Then you get that nice Santa Claus rally into the end of the year. And then bam, market rolls over on itself. So kind of in that time frame, let's kind of mark it out right here. So here is December 2nd right here. This is middle of December right here. Market drops ahead of the end of the year, and then bam, right there is the end of December, beginning of January, and then the markets roll over on themselves. So that's how I could see this playing out for the rest of the year based on what happens, mostly every year for Wall Street to be able to get their bonuses. They got to dump the market to be able to pump it in order to get their bonuses. And everybody's, happy, and we get a nice Santa Claus rally. Let's take a look at Bitcoin here. Bitcoin continuing to kind of hang in this range here. The real question is it going to continue to roll in this range of about 15.5 to 17.5 for a while and then follow the markets down to the next level ahead of the end of the year? And is this kind of setting up just like right here from the last time, right in this area here and right in this area right here and this area right here? So is the market kind of setting up just like it did here before the next leg down, popped up into the drop here, popped up into the drop here? So is that what we're seeing? Markets popping up into a drop along with traditional markets ahead of on the 13th and 14th. 13th is inflation print. If that's bad, if it's a higher inflation print, then the Fed's definitely going to be potentially considering 75. And I think we'll hear some telegraphing of that move next week ahead of the following week, which will be the week that the Fed makes their decision and the inflation comes out. So we'll know next week probably for sure that if they're going to raise 75, we will probably know it because he doesn't want to surprise the markets. If it's 50, we're going to know that. That's kind of what he signaled here recently. So that's kind of what I'm looking at on the markets there. And then we get into the debate once we get through the end of the year. So we have the inflation print. If it comes in hot, they're going to have to be a little bit more aggressive. Tough talk, maybe go with a 75 basis point rate hike. Gets us to the end of the year. We'll get the big dump and the big rally into the end of the year. Then we go into Q1 next year, and that's when the whole recession discussion debate begins. Are we going to be in a recession? How long? How far? How fast? How high does the Fed need to take rates? How long do they need to keep it there? How restrictive are they going to be on policy? And what does the consumer look like once we get through the end of the year, right? Because the consumer is resilient right now going into the end of the year, the holidays, everybody's getting bonuses. They've got severance if they got laid off. Credit cards are getting racked up. There's still a lot of cushion that the consumer has. They're going to have their holidays. They're going to spend their money. But then when we get into next year, that's when people really start pulling back because you have tax season, you have inflation that's still a problem, you have job losses. People start to think a little bit differently once we get ahead, get through the holidays and get into next year, and you're facing tax season and all that. Of course, taxes aren't due till April, but people start thinking about it, come January, because you're getting those tax forms in to start figuring out what your liability or refunds are going to look like. So Q1, Q2 next year will be telling, and we're going to then find out what is this economy going to look like? Is this going to be an economy where we just deal with higher inflation and wages are higher and we just kind of continue to float along and the market kind of continues to deal with that? And then where does all the capital go that's out there that needs to be invested? So we know there's sovereign wealth funds. We know that there's life insurance companies, there's pension funds, the funds that have to allocate. They have to pay premiums. They have to pay pensions. They have to generate returns to keep the Ponzi going, right? Kind of like Social Security. You got to have people continuing to pay in. You have to make money on that so that it can be paid out. The benefits can be paid out. So your pension benefits need to be paid out. Your life insurance premiums and settlements need to be paid out, or settlements and things need to be paid out on life insurance. Endowments need to earn money. Colleges, institutions like that. So there's capital out there that has to be allocated, that has to come into the space. What happens when they lose money? They're all down. So when they lose money, they have to sell in order to cover pensions, to cover redemptions, to cover, premium loss and settlements and things like that. So they sell to cover those. And then they're going to have to start digging into what they would be investing in order to continue to pay. And eventually, if they're not making any money and the markets are still down, then they can eventually be in some serious trouble. This is states, cities, local state governments. This is, like I said, pension funds that can be, unions, can be private sectors. This is life insurance companies that, have to pay on claims. This is sovereign wealth funds that need money to continue to operate their economy. Things like that. So these are the things that have to put money to work. They have to earn, but if they're not, they got to sell so they can take care of the obligations. If they can't sell, once they run that down, then they have to dig into what they would be investing. And then eventually that well runs dry. And then you have a situation like we saw in the UK when all of that was happening with the pension funds over there that could not meet redemptions and premiums and things like, or payments and things like that. So these are the things I'm looking at. We've got a lot of stuff coming up and a lot of data to look at and get ready for. And of course, Q4 into the year earnings, all that kind of stuff. So this is going to be a big month. But right now I'm in the camp of a Santa Claus rally. Got to dump it to pump it to hit those bonuses. So that's the thing about Wall Street. The good news of having Wall Street on our side for the end of the year pump could be some nice moves to be made. VIX is down. Remember, when the VIX is below 20, that's the time to sell. When the VIX is above 30, that's the time to buy. So this could be the end of the rally for a while, for a few weeks until we get towards the end of the year, and then we'll go from there. But, of course, that's just speculation at this point. We've got the inflation print, the Fed's response. We've got a little bit ahead of us yet to digest before we can, really see what's going to happen. So these are the things I'm looking at. I'll see you in the next video.